Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast, a series exploring capital, governance, investor psychology, and the principles behind building enduring investment platforms. If you've been listening since the launch episodes, you'll know this podcast is not about market noise, short-term speculation, or investment theatre. It is about understanding how sophisticated capital actually thinks. Because when you understand how capital thinks, you begin to understand where it flows, and more importantly, why it stays. Today we're going to explore a topic that separates institutional platforms from fragile ones, a topic rarely discussed outside investment committees, a topic that experienced allocators often recognise within minutes. That topic is governance. Not governance as a legal requirement, but governance as an investor signal, because long before capital analyses returns, it analyses behaviour. Segment 1, the quiet question. Every investor is asking. There is a question sophisticated investors never ask out loud, yet it sits beneath almost every allocation decision. The question is this: what happens when something goes wrong? Not if, when. Markets correct. Projects stall. Liquidity tightens. Cycles turn. None of these events are unusual. What matters is how a platform behaves when they arrive. Governance is not built for the sunshine. It is built for the storm. And experienced capital knows the difference immediately, because platforms without governance tend to rely on personality. Platforms with governance rely on process, and capital always prefers process over personality. Segment 2, why governance has shifted from defensive to strategic. Historically, governance was seen as a defensive tool, a mechanism designed to prevent misconduct. Today, it has become something far more powerful. It has become a competitive advantage. Why? Because private markets have matured. Institutional investors no longer chase opportunity alone. They evaluate infrastructure. They ask, who oversees deployment? Where are the controls? How are conflicts managed? Who challenges decisions? What prevents style drift? Governance answers these questions before they need to be asked, and in doing so, it reduces perceived risk. Here is something many emerging managers underestimate. Lower perceived risk attracts larger capital pools than higher projected returns. Let that sink in, because it reshapes how serious platforms are built. Segment 3, governance is a signal of intent. When investors review a platform, they are not just analysing structure, they are interpreting intent. Strong governance communicates something powerful. We are building this platform to endure. Weak governance communicates something equally powerful. We are building this to grow quickly. Sophisticated capital is not searching for speed. It is searching for durability. Remember this. Anyone can construct a vehicle. Few construct institutions. And governance is the architectural blueprint of an institution. Segment 4, the psychology behind investor trust. Trust is often misunderstood in investment markets. It is not built through marketing, it is not built through projection, and it is certainly not built through charisma. Trust is built through predictability. Governance creates predictability. Predictability reduces uncertainty. Reduced uncertainty attracts capital. This is not theory, it is allocator psychology. When an investment committee sits down to review opportunities, they are not asking, is this exciting? They are asking, is this dependable? Excitement attracts attention. Dependability attracts allocation. Segment 5, governance as a form of respect. There is another dimension to governance that deserves discussion, one that is rarely articulated. Governance is a form of respect. It signals respect for investor capital, respect for fiduciary responsibility, respect for longevity. When investors sense this mindset, something subtle happens. The conversation shifts. You stop being viewed as a sponsor seeking capital and begin being viewed as a steward of capital. That is one of the most important transitions a platform can make, because stewards attract partners, Sponsors attract transactions. Segment 6. Governance begins earlier than most founders think. Many founders believe governance can be added later, after scale, after momentum, after fundraising. But sophisticated investors read early decisions as predictive signals. The platforms that embed governance early often become the platforms institutions grow alongside. Because early discipline suggests future discipline. Think of governance as cultural, not procedural. It is not a document, it is a mindset. A mindset that asks, are we building something impressive or something enduring? Segment 7. What sophisticated investors notice immediately? Let me share something that may surprise you. Experienced allocators can often assess governance maturity within a single meeting. They listen for language, they observe decision frameworks, they watch how risk is discussed, and most importantly, they look for independence, independent oversight, independent challenge, independent reporting, not because they expect perfection, but because independence reduces the probability of unchallenged error. And unchallenged error is what destroys platforms. Not volatility, not markets, not cycles, but unchecked decision making. Segment 8. Governance protects more than capital. There is another benefit founders sometimes overlook. Governance protects the platform itself. It protects reputation. It protects decision integrity. It protects long-term strategy from a short-term pressure. Because as capital scales, so does expectation. And without governance, expectation can quietly begin steering the platform instead of the platform steering itself. Enduring institutions maintain direction. They are not pulled off course by momentum. Segment 9. The future will belong to structured platforms. If we step back and look at the trajectory of private markets, the direction is unmistakable. Capital is concentrating, allocators are consolidating relationships, and infrastructure expectations are rising. The next decade will not simply reward opportunity, it will reward structure. Platforms that recognize this early will not need to chase capital. Capital will increasingly seek them. Closing reflection, a question worth considering. Let me leave you with a thought. When investors encounter your platform, what signal are they receiving? Are they seeing ambition or architecture? Because ambition attracts curiosity, but architecture attracts commitment, and the platforms that endure are almost always those designed with intention from day one. Thank you for joining me for this episode of the Ben James Smith podcast. If these conversations resonate with you, I invite you to subscribe and follow the series. In the episodes ahead, we'll continue exploring the principles behind enduring investment platforms, how sophisticated capital evaluates risk, and what truly separates institutional managers from the rest of the market. Until next time, remember, capital does not merely follow opportunity, it follows conviction, discipline, and structure. Thank you for listening. Speak soon.